welcome to today's webinar, the title of which is Delhi's Dilemma, How to Balance Global Politics with Economic and Investment Risks, brought to you by UK-based Ocean Dial, investment manager of the Gateway of India Fund. My name is James Crabtree. I'm joining you this evening from Singapore, where it's about 9 o'clock in the evening. I'll be your moderator for this evening. I am here to introduce an all-star cast to talk us through the topic of the moment, namely how the aftermath of the conflict in Ukraine and the geopolitical tumult that has come with that has affected India, and India has responded to it, and how that in turn is shaping the way that investors are looking at India as an investment destination, both in the short term, given the movements in the market today, but also over the coming period. In a second, I'll introduce my panel, but just a few moments of housekeeping. We're due to go on for an hour, and we'll wrap up promptly at the top of the hour. You'll hear from my three speakers in just a second. Then we'll have a discussion amongst ourselves, and I'll leave plenty of time for question and answer, which you can drop your questions into the chat function at any point, and then I'll address them to our three panelists. The session today is on the record, so it's being recorded. So any question that you ask will or could end up on YouTube. That being said, I think we'll still get a very frank and thought-provoking set of comments from our panelists, and we appreciate any questions that you might ask. So, in order of appearance, we're going to go from geopolitics to economics to investment. Our first speaker joining us today from Australia, so quite late at night, I think it's 11 o'clock where she is Tanvi Madan. Tanvi is a senior fellow in the Project on International Order and Strategy in the Foreign Policy Program at the Brookings Institution in Washington. And if that isn't enough, she's also director of the India Project and the author of an excellent recent book, Fateful Triangle, How China Shaped US-India Relations During the Cold War. Really, there's nobody better to talk about India's geopolitical position relative to the United States and China, and she has a sideline expertise in Russia too. Following Tanvi, we're going to hear from Jim Walker, joining us from Edinburgh, where apparently it is sunny, remarkably. Jim is the chief economist at Aletheia Capital Limited, normally based here in Asia. And then finally, to bring the Indian markets perspective, we're joined by Tridib Pathak. Tridib is co-head of equities at Ocean Dial Asset Management, our hosts, and principal advisor to the Gateway of India Fund. So I've asked each of our speakers to speak for about 4 or 5 minutes to kick things off, and then we'll get straight into the discussion and Q&A. So Tanvi, do you want to start us off? You've been watching, some of our guests today may follow you on Twitter, and so they might know that you've been following very closely the back and forth that India has had over its relations with Russia, and the kind of complicated position that India has been trying to strike in the aftermath of the Ukraine invasion. Do you want to give us your sense of the big picture here of how India is trying to position itself and what its constraints are?
Sure, James, and thanks for that introduction. I think I'm going to step back a bit just in terms, because of the interrelated nature of geopolitical developments facing the Indian government and how they connect to what India is facing as it tries to approach the Russia-Ukraine war. Over the last kind of 2 years, there have been 4 critical developments that the Indian government has been grappling with that have had multi-domain implications for them. 3 of those are geopolitical developments. The first, which is kind of a multi-domain, I guess, development on its own, is COVID. The second was the US withdrawal from Afghanistan. The third is the China crisis that they're facing at their border. And finally, most recently, the Russian invasion of Ukraine. I'll just mention kind of a couple of those a little bit in detail, and because I think they're connected, there's spillover from them across out of the geopolitical domain into several other ones. One is the kind of India-China crisis and where it stands. India-China relations right now are at their lowest point since the two countries fought a war in 1962. This is on account of the escalation of their boundary dispute, which happened about 2 years ago. It resulted in the first fatal clashes at the border in decades, and it is still ongoing. They haven't been in clashes recently, but the boundary dispute itself continues. This is a real inflection point. It's not just another boundary crisis, and there have been a few since Xi Jinping took office, but this is different. This is an inflection point as far as India is concerned. It has changed India's view of China and its relationship with China, which will not go back to that 2 years ago for several reasons. But just briefly, kind of why it's changed, why I think this is an inflection point and has broader ramification is, for one, it has changed the debate in India about China. India has seen China as a challenge since the 1950s, but not to this extent. It thought it could manage the China challenge. It could compete, but yes, cooperate as well. There was a debate about whether, how much competition, how much cooperation, what China's intentions were. That debate in India about China is over. There might be a debate about how far and fast to get closer to the US and other like-minded partners, but the debate about China in India is almost done. The idea is that China is India's primary strategic and economic and technological and even ideological competitor. India sees, and this is the reason this debate has almost ended, is that they see China as having used force to unilaterally change the status quo in violation of several agreements that the two countries signed. And this leads to the second reason this is an inflection point. It has changed because India sees China as having violated commitments and agreements. It has changed the boundary deployment. So today now you have, which is different from before, you see an India-China border that looks much more like the India-Pakistan border with forward deployed troops, which you had not seen in the past. Third, you've also seen in the India-China relationship since this crisis, changes in India's domestic policies. India has imposed extra scrutiny or restrictions on a variety of Chinese involvement across sectors. Not just economic, but education, civil society, but in the kind of economic domain in terms of FDI. This went back to even on account of COVID, FDI restrictions on Chinese companies. You've seen restrictions in the telecom space, in the technology space, amongst others. Finally, on this, you've seen foreign policy impacts from this crisis, which include a deepening of Indian ties with the US alone, but also with other like-minded partners, and India's decision to deepen its involvement in the quadrilateral, the Australia, India, Japan, US grouping, despite objections from Russia. Nonetheless, this China crisis has also reinforced for India because its need for defense equipment from Russia, in which it is dependent, some would say over-dependent. It has reinforced the necessity to keep Russia on side. And that really is what is primarily, though not, albeit not the only factor shaping India's approach to the Russia-Ukraine crisis, this dependence that India has on defense equipment from Russia, though it's been trying to diversify, existing frontline equipment is still largely of Russian or Soviet origin. And that means in the context of India worrying about an escalation at the China border around this time of year through the summer, these tend to be sensitive moments at the border, there was a sense that you could not cut off channels of communication to Russia by condemning it. That in combination with, for example, concerns about Indian nationals in Ukraine, for which India needed Russian buy-in to try to evacuate them. India also has other irons in the fire with Russia, not in terms of kind of energy imports, as some have discussed, but more in the sense of cooperation in international organizations sometimes, but also nuclear and space cooperation. So it's tended to be more kind of on the defense and security side, but that to a pretty transactional relationship, albeit one India is dependent on. I will kind of say that despite this, you've seen an India that has been pretty adversely, despite the attitude that India has taken, which is not to condemn Russia, but criticize its actions, India has been pretty adversely affected by the Russian invasion of Ukraine. Economically, you've seen whether it's commodity prices in particular, but the inflationary pressures that India is feeling from that increase has been significant. You've also seen India have security implications from the fallout of the crisis, and then strategically, a lot of pressure on India's ties, some of which has been mitigated, considerable amount which has been mitigated on India's ties with the US and Europe. But you've also seen India now worrying a lot about a Russia that will be more beholden to China, which means India's partner, Russia, suddenly perhaps taking China's side in another China-India crisis. This is of deep concern to India, given its dependence on Russia for military equipment. I'll wrap up with saying, these two crises, the India-China crisis, the Russian invasion of Ukraine, combined with the kind of fallout of COVID, has these three developments have increased or reinforced Indian concerns about India's exposure across a range of domains. And what you've seen particularly is a revived discussion of supply chain resilience, about India's dependence on the external environment. And this has led to this discussion about supply chain resilience, about resilience more broadly, has led to kind of two strains of thought. One, to bring production back home. So reshoring, this is not unfamiliar in other countries, but thinking about reshoring, which poses challenges and opportunities to companies and investors from other countries as well. Opportunities because it opens up space for anybody who's not China. Challenges because some of the policies being put in place could be protectionist and could lead to kind of restrictions, sometimes inadvertently on others too. The second thing that it's led to, one is reshoring, the other thing is diversification, which is looking for alternate suppliers. This is an opportunity, I think, for anybody who's not China in terms of thinking about India. So think about it as friendshoring, it as diversification, but essentially India's search for like-minded partners and alternate suppliers.
Perfect. Thanks, Tanvi. That's a great overview. So I think we've got the sort of geopolitical context here. Let me turn to Jim in sunny Edinburgh to talk us through, Tanvi already mentioned some of the immediate economic consequences for India in terms of higher commodity prices, food prices, inflation. But can you talk us through, in a sense, how you see the economic outlook? So Jim, over to you.
Thanks very much, James, and good afternoon, everybody from Edinburgh. Let me just start by saying I'm quite interested in what Tanvi's just said about the China-India debate has just ended, and India has decided that China is a competitor and will look away from China from now on. I think that might just be about the worst timing of a decision in history, because I think what India at the moment is reacting to is Xi Jinping and the kinds of policies that he's brought with him to the table over the course of the last 8-9 years, just at a point where I think his power is waning and his position is more under threat than it's been since he took power in 2012. But let me come back to that in a second, because I want to start off just with an overview of what's happening in the global economy at the moment. We're at the stage just now that, of course, interest rates are rising in the US, they're going to start rising in other countries, they've already started in India. But we haven't really got to the point where the bad news is truly beginning, and that will be the downturn in economic activity that follows. In its World Economic Outlook at the end of last year, the IMF was looking for around about 4.9% global output growth in 2022. By April, in its update, that outlook for global growth had fallen to 3.7%, and in our view remains exceptionally high in comparison to what it's actually going to get. Because one of the key countries that it forecasts is growing at faster than global output is China at 4.4%. Well, the truth of the matter is that China will be lucky if it can grow at 2 this year. And that's really all down to economic policies that have been enacted by the current government and Xi Jinping at the centre of it. As probably many of you know, China has a zero COVID strategy, which is actually not just a zero COVID strategy, it's a zero COVID, zero death strategy. And over the last 2 years, that's been sold to the population in China as a tremendous success. And hence the reason that you've seen such draconian shutdowns in places like Shanghai over the course of the last few months, when the Omicron variant managed to get into the Chinese economy. What we're going to see is a continuation of that, certainly through the second quarter, until such time as China can change that policy, and change it will, because it knows that it can't control the virus anymore. And that means taking some time to get the message down to cadres, but then abandoning the zero COVID strategy, which means weakening Xi Jinping's position in the run-up to the party congress in October. At that point, he'll still become the leader again for the next 5 years, there's no doubt about that. But he's used up a huge amount of political capital on a subject area, the pandemic strategy, that's going to turn round, I'm afraid, and bite him in the back, which means that he's going to have to start compromising in a lot of other areas. And one of those might just be the border dispute with India, who knows? So I think we should be prepared for a much slower China. We should be prepared for a slowing in the United States, but much, much higher interest rates to begin with. Over the course of the last 2 weeks, when I've been talking to clients and economists around the region, I've been asking them what they thought the neutral Fed funds rate was, because that's just the starting point for addressing inflation. Now, we're currently at 0.75 on Fed funds rate. The optimists think that neutral is 2.5. So that's another 175 basis points to go. And then you would need at least another 100 to 150 over that to bring the inflation numbers down, by which time probably a lot of the zombie companies and very indebted corporates in the United States will have gone bust. But we should be preparing ourselves for at least 2 or 3 more interest rate rises this year, accelerating to between 75 and 100 basis points by the end of the year, and then more in 2023, bringing with it, I'm afraid, a fairly significant recession globally in the course of 2023. Finally, maybe just what I want to mention is India's position, because Tanvi's already alluded to it as regards Asia potentially reshoring or deglobalization and where India stands. I think we've got to remember that India is currently accounting for around about 5% of monthly exports from Asia to the rest of the world and throughout the region. Its export size is a fraction of China, China's about 8 times bigger than India on a monthly basis. India is the 7th biggest exporter in Asia, and I'm afraid about to be the 8th biggest, given that Vietnam is likely to overtake it in the next few months. But that's only in terms of the export profile. In terms of foreign direct investment, it really needs to get its act together even more at a time when other countries in the region are exploring foreign direct investment avenues as well. So it remains to be seen whether India can do that. And I think Deglobalization will be actually talking about that in his presentation. Finally, just to say that at least one thing you've got to hand the Reserve Bank of India. When the Americans raised interest rates 50 basis points last week, immediately India raised 40 basis points. And that was an excellent signal from the RBI that it's not going to let the currency go over the course of the remaining months of the year. It will be defending it quite rightly. So good move from the RBI in very difficult economic conditions globally.
Very good, thanks, Jim. That was a terrific overview. There's a lot to come back to there, both about the reshoring, but to which I think we should come back to. But before we dive into any of that, let me go finally to Tridib. So Tridib, you're in a sense in our triumvirate of speakers. You're giving us the investment perspective. So having listened to what Tanvi and Jim have said about the geopolitical context and the macro situation, I mean, how do you see the India story holding up, and what's the outlook as you're seeing it? You're on mute, Tridib, so you need to unmute yourself.
Thank you, James, and thank you all the participants for giving us the time. We want to make 3 points out here in the context of the topic. The first one is resilience. Okay, clearly India is vulnerable. Crude oil price of more than $100 per barrel is definitely quite a difficult task for India to face, and even if it remains high for a long period of time. So the vulnerability of India clearly is on the commodity prices. It's not just crude oil, actually, it's also edible oil prices, in that sense, and dependence on imports of edible oil. Having said that, what we find is there is a clear change in terms of the relative ability of India to face these challenges. So there has been a lot of work which has been done over the last few years by the current government and the policy action, which has specifically, to begin with, focused on macroeconomic stability and reducing India's macro vulnerability, so to say. So over the last 5 to 7 years, India has effectively reduced the band of its inflation. It used to be in the region of 8 to 10%, and successfully we brought it down back to around between 4 to 6%. Current account deficit was well controlled and almost very negligible in that sense, brought down with specific policy actions. And there was a lot of fiscal consolidation just pre-COVID. Okay? So these factors laid down a very strong entry point for India into the COVID crisis and into the current crisis, where compared to its own historical past, and I'm saying just relative to the past, India is far better placed and far better, in a better situation to withstand some of these challenges, which definitely are challenges, and India will have to grapple with them. But that's another point we thought we should make. It is not very surprising to see the kind of resilience Indian equity markets have shown in the current year, including the behavior of the rupee. It is very surprising to see that the Indian markets have been one of the better performing markets so far year to date in the last 5 months, after having done very well last year. And the rupee has just so year to date. So that basically comes out of the fact that you have a very strong amount of foreign exchange reserves, about $600 billion, which can and has been used by the RBI to effectively intervene. And of course, it is interesting to note the resilience of the Indian markets in the context of a very large outflow of foreign portfolio investor monies. So FPI outflows have been around $22 billion for the last 6 months. Mind you, this outflow is quite some in the history of India. We've never seen a $22 billion outflow from the stock markets in a matter of 6 months. But there again, this has been more than compensated by a very strong domestic institutional force, which essentially reflects mutual fund and insurance monies. So this is the first point we wanted to make is on a comparison to the past, there is definitely a good amount of resilience which is coming through, though the vulnerability remains. There is no doubt about that. The second point, which the other panelists also referred to, in a way, is about deglobalization, and there's much debate about that. And what we find is deglobalization. We don't know whether global trade will come down or peak out. Has it peaked out? But the fact remains that for us, deglobalization to start with would be in China +1 and diversification of supply chains. We've interacted with so many Indian companies over the last 3 years. This trend actually started even before COVID. We've seen successful market share gains by electronic manufacturing services companies in India, by specialty chemicals companies, and even textile companies, and that trend is now being accelerated by the government of India in the last 2 years through its production-linked incentive scheme. The PLI scheme, as it is called, is targeting 15 sectors, and this is a very targeted scheme where the government is going to spend nearly about $35 billion over the next 5 to 7 years in terms of incentives. So that it can enable nearly $450 billion worth of production value to be created. And all this is targeted not just towards encouraging more domestic manufacturing from domestic companies, but also attracting foreign direct investment in terms of global multinational companies setting up manufacturing base. Apple being the case, Apple has already started production in India through all its manufacturing partners, the Foxcons and Pegatrons and Winstrons of the world. So that's a very big trend which we see. So deglobalization in the context of the world would mean, in a way, China plus one, which probably could work towards India's advantage, as and when India is able to take more and more advantage of it through government policy and through private sector initiatives, which looks quite likely is on its way as we speak. Interestingly, I was reading through management consultant Kearney's report. They have an index about reshoring index, and that index has been negative for the last 2 years, which means and this is about US. A negative reshoring index means US is actually not reducing its imports; it's increasing its imports. But the interesting fact is the same Kearney has a China diversification index, which clearly shows that in the last 4 years, the share of China in US manufacturing imports has come down from 66% to 55%, which means they are increasingly outsourcing from other low-cost countries in Asia, and that would also include India, interestingly. So you're seeing the beginnings of maybe a global trade may peak out or may go down, but the share within that is probably beginning to shape up and move, and India probably has the right policy initiatives to take advantage of that and invite more and more foreign direct investments also in the process. The third point, of course, is opportunity. We think while these challenges in the short term are definitely quite serious, the long-term structural story of India is pretty much intact. In fact, if I step away from the macro, it is very clear that India is a stock picker's paradise, considering the sheer breadth and the depth of opportunities in listed public markets, which you have in the case of India. Probably the biggest breadth and the deepest depth, I can say, in comparison to other emerging markets. A significant amount of economic activity is represented in the Indian stock markets, enabling participants to respond, and invest. And when you have long-term structural growth in the region of even of not 8% but 7%, what it leads is it evolves. It allows businesses to evolve. So just to give an example, in the last 7 years, the number of companies with a market cap of more than $1 billion has gone up from 70 to 350 in a matter of 7 years. In fact, the number of companies with a market cap of more than $5 billion has actually gone up 10 times. What it only shows that you not only have very strong bottom-up possibilities, but very diverse possibilities and a large basket of companies. Unlike most of other emerging markets where there is a lot of concentration of a couple of sectors or a few companies in terms of domination of those markets, in terms of investable opportunities. But having said that, the next few months will definitely be quite interesting from a volatility and challenging, no doubt. But we believe that they may also be may sow the seeds for a very strong long-term investing. Thank you, James.
Good, thanks, Tridib. Okay, let's get into it. So let me come back to Tanvi. So we've sort of gone through the waterfront there, from geopolitics to economics to what this means for India Tridib giving us the slightly more optimistic case for the fact that you should be optimistic about India as a growth market. But let's just go back to the geopolitics and where we are at the moment. If you're sitting in Narendra Modi's office or External Affairs Minister Jayashankar's office, what are you worried about in the Russia situation? I mean, we know sort of what's happened for the last 2-3 months, but is there a scenario in which this gets significantly worse for India, or is in a sense, have they now coped with most of what this crisis is going to throw at them?
I think they are worried that it will get worse, and I think in two ways. One, the duration and outcome of this crisis is uncertain. We don't know how it's going to end. We don't know how long it's going to last. The concern for India would be on that the longer it lasts, the potential kind of the response from everybody else, particularly the West in terms of sanctions, etc., that you will see a weaker Russia. And you will see a weaker Russia that will become more dependent on China. For various reasons, this is not an environment that India wants to see. You'll also see a Russia that, even if it wanted to supply India, could not supply India the defense equipment that India might need, that India does need, but might need particularly if there is a crisis. You also are going to continue to see the food security situation potentially worsen. India, other than if you're kind of a wheat producer in India, this crisis is perhaps of benefit, but we don't know what the wheat crop is going to look like this year. India had hoped that they could be kind of the alternate provider for other countries. But whether it's edible oils, whether it's kind of other crops, you are starting to see India gets and other countries get a lot of, for example, their wheat, but other cereals as well from Russia and Ukraine. And so I think the food security impacts, the energy security impacts for India, as Tridib mentioned, also kind of it's not just kind of crude. You're also going to see kind of spillover effects, as well as kind of into other commodities. And so I think they're worried. They're quite worried about the kind of the duration and of this crisis and what it does, not just to Russia, but the continuing fallout. In terms of kind of their own position, I think you've steadily seen them actually become, in their own way, critical of the Russians, something the Biden administration and European governments have recognized. They will not come out and call Putin out by name or Russia out by name, but you have seen their tone becoming increasingly critical, particularly about the massacre in Bucha, for example. But also they have kind of dropped references that they used to use that indicated that they thought legitimate security of all interests of all parties was at stake, essentially saying that they didn't think there was any excuse for Russia to take the steps that they did. So I do think their own position, if we see a much further escalation, the use, for example, of nuclear weapons or chemical weapons, you might see that go further, and that will be another thing they worry about, that this will get worse. But I think those are the kind of things that will probably keep them up at night. But I would add a kind of a fourth dimension to that, which is what I think really keeps them up is that there will be a combination of a deteriorating situation in Europe and potentially Beijing taking advantage of the situation, of the world's attention being focused on Europe. And taking further action at the boundary. So the probability of that is debated, but that is something they have to worry about, particularly given that they are concerned about the arms supply chain from both Russia and Ukraine.
Good, thanks, Tanvi. That's great. I should say for those of you that we've got some really good questions in the chat. So Adam, Ken. Hiran, various of you, I'll get to your questions in a second. I just want to go around the panel one more time. Jim, so you also had a slightly gloomy outlook, as one would expect from someone in Edinburgh, that the worst is yet to come. But could you focus in on India a little bit? I mean, I suppose there are two questions given what Tanvi has laid out about the circumstances, which is firstly, what's the specific economic outlook for India in the kind of global picture, and I suppose relative to other peer emerging markets? Is it more or less vulnerable to the effects that we've seen? Tridib gave an optimistic view. I mean, how do you see India shaping up relative to the way that asset allocators might think about different markets? Now, you're on mute as well, Jim.
Sorry about that. I suppose it depends a wee bit if we're concentrating in the short term over the next year or so, or the long term over the next 5 years. And in terms of the short term, where we're looking at a significant slowdown in the global economy, then India, not being a hugely open economy, doesn't suffer as badly from that. It takes much more of a toll on some of the other Asian exporters, even places like Korea, Japan, China itself, if the global economy is slowing. India, not so much the case. So there's a degree of resilience there, but you can't just have resilience on the external front without doing something on the domestic front to generate more economic opportunities. Now, interest rates are not going to be the tool that can be used over the course of the next year to either reduce the cost of money or to stimulate the economy, purely because India will have to follow to a certain extent what's happening elsewhere. Otherwise, the currency gets hurt badly, and then, even though currency is going down, means that there's more competitiveness in their export sectors. If there's no demand for exports, then it doesn't actually matter. All you get is a currency going down and cost pressures going up, which is actually bad news. So this is one of the points in history where a weakening currency is not an advantage to any country, regardless of whether they're big exporters or not. So the RBI has got this right, but that then means that the government has to do more on its front to generate a bit more economic growth. And I think that this takes us a wee bit more into the longer term as well. There have been very good moves over the course of the pandemic. There's been a very significant restructuring in the banking sector in India. There's been consolidation of public sector banks. There's been recapitalization. The financial system looks very ready to support economic growth in the country, much more so than has been the case over the last 5 years. And at the same time, the government has done some things in terms of labour law reform and direct investment, foreign direct investment reform. Both of these will be very positive in the longer term. But India has to get out and market itself in the global economy as a place where foreign direct investors can come, settle, and be comfortable with the economic environment. That's something that it has failed to do over the course of the last 20, 30 years. Hopefully, going forward, it's something that it can bring itself a bit more to bear the guns on people who are looking for alternative places to invest and make India one of those places.
And so, Tridib, it seems like you and Jim, you're coming at this from a slightly different perspective, but you seem to be saying to me the same thing, which is things could be pretty choppy for the next 2 quarters, but there are some longer term positives to weigh against these geopolitical currents. Is that a fair summation, Tridib, before we go to the audience questions?
That's right. Yeah, I would agree with that. And just to add a couple of points which Jim was referring to, in terms of policy action, I was talking about the macroeconomic stability part, how the pre-COVID the government achieved that well, and fiscal consolidation. But suddenly in 2021, the government switched gears and they moved in for fiscal accommodation, accepting a higher fiscal deficit. But that came not with an improved quality of the fiscal deficit. So just to give you some numbers, the government capital expenditure to GDP is actually doubled in the last 3 years, so 1.5 to nearly 3.2% or so. So a large part of the fiscal deficit accommodation has been more geared towards productive capacity rather than handouts rather than redistributive policies per se. Focusing more on creating the productive capacity of the economy from a longer term perspective. And of course, a lot of actions like the national infrastructure pipeline, which is underway, it's more than $1 trillion. And of course, the production linked incentive scheme, which we talked about, is laying the foundation for a capex-led, investment-led, growth support towards the economy from a policy perspective, I would think.
Okay, great. All right, thanks. Let me go over to a few audience questions. I'm going to start with Matthew Reed. This is probably one for you, Tanvi, because it's about domestic politics. So Matthew asks, given India's dependence on imports for oil and gas, the price of these commodities is rising, and how does this feed through into the cost of living? So I suppose before we start thinking about reforms and the domestic policy agenda, we need to think about how these effects are affecting the government. So can you just give us a quick minute on, is Modi himself under pressure already because of cooking oil and things like this?
I think, they have allowed, for example, gas prices or petrol prices, as they call them, to go up, including also some, LPG cylinders, those kind of things. Part of that was they had kept the prices down. They had not been passing on the price due to state elections. So you are seeing increases. Having said that, what you're more likely to see if they do start to see kind of more concern amongst the public is that you'll see, I think the government subsidy bill is going to perhaps increase over time. It's going to increase anyway because another thing whose prices have increased is fertilizers, which again is heavily subsidized. So far you're not seeing, you're seeing complaints, but I think there is a recognition. And in fact, when Prime Minister Modi's party won a number of the state elections that were held just after, it wasn't related, but the results were declared just after the invasion. He, in fact, prepared the public and said, look, you are going to see an increase in prices. And now there aren't elections, another set of elections for a little bit. So they have some breathing space, including some state elections later, but not right now. So they do have some time. And you do tend to see them manage kind of public discontent. But again, this is the advantage of a democracy. There are various safety valves, whether it is, grumbling on television channels or the press or through state elections, but you're not going to necessarily see it, spill over. And India's economy is not in the situation, for example, as Sri Lanka's is in. And so the government does have tools through which to kind of deal with some of the kind of discontent there could be just in terms of having some fiscal space, which a country like, for example, Sri Lanka, if that's what you're thinking of, just doesn't have. And so I don't think you've seen that kind of backlash yet. But then again, there's also some time till the next state elections, and I think they will try to change their approach to reflect that.
Let me ask you one more political question, which has come in from the audience, which is about the relationship with China. So, Jim, you mentioned this as well. But we had a question asking about how the deterioration in Sino-Indian relations is going to affect business, and in particular, whether you're going to see the wholesale disinvestment and exclusion of Chinese businesses in general. So internet businesses, we saw some apps being banned and different online platforms, but is that something to be aware of in future, do you think?
I don't think you're going to see a complete kind of decoupling, so to speak. I think, and you've already seen, as several people have pointed out, more broadly, that there have been, for example, the trade numbers have actually gone up now between China and India over the last year. Having said that, the trade numbers, for example, between the US and India have gone up even more, and India's trade numbers on average have gone up more. So the trade increase between China and India is lower than it is for India, and this is post-COVID, obviously, recovery. I think, you just investment, there wasn't that much Chinese investment in India. It had started to pick up. It was particularly directed at the tech sector. I think you're going to see is certain areas where India is going to restrict China. Anything that is considered strategic or kind of critical and emerging technologies, critical infrastructure, you are going to see restrictions. The Indian Home Ministry recently released figures of about 350 new Chinese applications for investment. Only 66 were approved. They were in kind of general sectors. They weren't in very kind of specific sectors where India would be concerned about things like the resilience or security of the systems. I think you'll see, for example, in infrastructure that is not critical or sensitive, you'll continue to see India welcome certain Chinese investment. You'll see it in other spaces as well, but I do think you will see specifically, now they don't name China in these kind of regulations. They say countries that have their land borders with India, but that essentially is China. They've also been trying to close loopholes from investment coming through either Hong Kong or through third countries. It has caused some issues for on the whole. It's been an opportunity for others who kind of filled the, for example, investment space in India's tech sector. They have not lacked for capital. There had been a sense that this would be a big hit. They themselves were concerned, but overall, it's been more than filled by investment from the West and from the Middle East as well. I will say, though, there have been specific instances where, for example, companies have got caught up in some of these restrictions in the tech sector, where either they have there's questions about Chinese investment in kind of the companies based in Singapore, for example, or for example, when some Western companies have tried to sell their assets in India that were meant to be sold to Chinese companies, and India has either stalled on giving approval of that or nixed it. So you have seen some fallout for others, but you've also seen, as I said, opportunity open up, because this is very much directed at China. India is moving to this idea of kind of trusted partner network. So if you're part of, that's what the term some people use is friend shoring. So if you are from kind of a like-minded state, it is not likely to affect you. In fact, India is more likely to welcome that investment to fill the hole that they are seeing from China.
All right. Well, since you're joining us from Australia, India even signed a trade deal with Australia not that long ago. Tridib, we had a question about reshoring, which links to what Tanvi is talking about. So the question noted that reshoring will be inflationary for Western economies, but that India, as you yourself said, has a strong potential, but maybe issues of cost competitiveness. And so I suppose you talked a little bit in your opening remarks about you had seen some positive signs of reshoring, but I mean, how far are you really optimistic that India is going to be able to gain substantial market share from companies moving location from China or even elsewhere in Southeast Asia? Or is this going to be happening sort of slowly and at the margin? How big a change do you think this could become?
Yeah, well, that's interesting. From a cost comparative point of view, I think, let's say if we talk about labor costs, Indian labor costs are far lower than China's, and now comparable to Vietnam, for example. So cost competitiveness is actually not an issue according to us. But what is the issue, which is probably now slowly being tackled through the FTAs? You mentioned about Australia, there was UAE also, and there is the UK and European Union FTAs also being discussed and negotiated upon. And there, India has a disadvantage so far vis-a-vis other countries like Vietnam in specific would be concerned, because they have a preferential duty arrangement because and India does not. So FTAs will probably open up that. A clear case being textile sector, for an example. We have a couple of textile investments in our portfolio, and it's very clear that there is a 9 to 10% disadvantage which India has in trading with UK or European Union, just because countries like Bangladesh and Vietnam don't have any duties. And so these FTAs are probably in that direction being expected to be taken upon, And one interesting thing why India would probably be able to attract more and more China plus one opportunities is actually not just exports. It is about the fact that just the way China was able to attract a lot of investment, not essentially for exports, but also foreign MNCs realizing that they get an entry into a very large domestic market. India probably will benefit from that, wherein it can attract export opportunities, investments which are geared towards export opportunities, but also corporations and businesses are looking upon that as an opportunity to gain entry into a large domestic market itself, which is actually evolving as you speak, in that sense. So I would think cost competitiveness would not be a key issue out here.
Good. I want to dig in a little bit into the vexed and ever-present issue of reforms and what the government might do, which some of you have touched on already. But before we do that, Jim, I had a specific question to you. Must be one of your fans in the audience, said you use credit growth and credit relatives as a tool. Looks like credit growth has been low in India for several years and in many other Asian economies. Does that give you optimism, or does it get overwhelmed by higher global interest rates?
Good question. Yes, somebody that has been reading our research over the years. Yes, India's what we call credit relative is below trend. In other words, the rate of growth of credit in the system is actually quite low and has been for some years now. But a lot of that was down to the problems in the financial system. The banking sector, public sector banks had big issues. The public sector banks having issues, people transferred business to non-bank financial institutions who themselves then started to have issues. And it took until, maybe under the cover of COVID, I'm not quite sure, it took until the COVID crisis for the government truly to get its hands around that and I think come up with solutions for the problems. And we now actually have a springboard in India in terms of the financial system, the private sector banks and the public sector banks to be able to support credit growth again. So I wouldn't read too much into the history at the moment of weak credit growth in India, and actually look maybe forward to the potential for pretty decent support for business in India if the right conditions are there to attract business and to encourage it. The banking system, I think, is just sitting ready to jump in and lend. I don't think higher interest rates from where they are just now will make that much difference to the demand for money. The truth of the matter is that Indian interest rates are actually relatively low compared with history. So I don't see that as a barrier. But the great news is that the financial system's ready.
That's a rare piece of optimism, particularly for those of us who watched the Indian financial system not be ready for quite a long time. Jim, one more quick question to you. I'm going to go round. We're going to go about 5 minutes to go before we wrap up. So we'll do a few more rapid fire final questions. One of our questioners pointed out, Jim, that you said India needed to get its act together in relation to FDI. So what do you suggest? I mean, this is a roundabout way of talking about the reform agenda, but I suppose FDI investors have particular needs. So what do you think would be, if you had the ear of Narendra Modi, what would you be telling him?
Well, two things here. First of all, what we need to realise is that everybody else is trying to get in on the same act. The Philippines have amended their public security law, which was in the 1987 constitution, to make foreign direct investment easier. Indonesia has introduced an omnibus law to make foreign direct investment easier. Thailand remains a big attractor of foreign direct investment, and so does China. Despite the fact that everybody thinks that we're deglobalizing, China remains a huge attractor for foreign direct investment. So at a country level, making changes might not be enough. There has to be very specific measures from governments to attract businesses. And this is one of the things that I really want to emphasize, that we keep talking about countries. Countries don't make anything. Countries don't do business with anybody. Countries with politicians keep talking about it as if they're in control. It's actually businesses that matter. Businesses trade with each other and they trade with people. And it's how what I would be saying to the Prime Minister, is it's how you set up the business environment within your country that will determine whether or not you're successful in getting foreign direct investment.
I mean, Tridib, do you want to take the same question? In your various remarks, you've sketched out a number of reforms that have been undertaken, but I suppose if you were also to have the finance minister or Mr. Modi, what would you tell them? What are the top one or two things you'd tell them to do to try and put some even more life in this India investment story?
No, I think what Jim said is probably spot on, and that's probably what Prime Minister Modi also has been talking about all the time, that it is for the government to create the policy framework and the environment for businesses to flourish and make their own decisions. And in that context, I guess a lot of policy action has pointed out towards that direction. Well, last year was probably the highest FDI flows in India, maybe around $85 billion, which compared to pre-COVID levels was an average of around $30 to $35 billion. So there is a significant progress which is visible in terms of inviting more FDI. I guess this year's target is probably crossing $100 billion in terms of gross FDI. So yes, in terms of creating the right framework and the right policy environment and the umbrella, I guess steps are being taken, and probably more steps will probably need to be taken on that direction. As the government policy says that they want a minimum government and maximum governance, in that sense.
Let me give the final word to you, Tanvi. I mean, we're having this discussion today because of the events of the last 2 to 3 months, in which a geopolitical earthquake in Europe has had ramifications around global markets. I mean, none of us really know what will happen in the future, but you have instincts, I think. I mean, do you think this is, in a sense, an unusual moment, or are we entering an era in which investors are simply going to have to cope with heightened geopolitical risk of one form or another as the part of kind of the ordinary cost of doing business, be it in Russia or US, China, or from some other source?
I think we're seeing, I do think just the kind of confluence of various storms that we're seeing, it will be a moment that we will think about. But I think what it's doing is, it's not necessarily creating new trends. I think it's reinforcing trends that we'd seen bubbling up, including, as Tridib mentioned, on countries thinking about things like supply chain resilience, diversification, the China +1 strategies, they proceed, as he mentioned. So I think you're seeing a reinforcing of certain trends. But I do think, for businesses, as much as, yes, I agree with Jim that, it's companies who make decisions, the decisions that governments make, which are shaped by these geopolitical dynamics, will create the space in which which businesses operate. And they will either make it hard for businesses and constrain what they can do in their own countries, in others. For example, the US considering restrictions on or scrutiny of outgoing investment as well, because of geopolitical considerations. You'll see India has done the same as well. And so I think you're going to see this across the board. You're going to see these trends perhaps in Europe, as you already have. So I don't think we're going to see, I think if anything, geopolitical and political dynamics in various countries are going to be especially on the geopolitical side, more volatile. But I think you are also going to see continuing, I don't think you'll see I don't use the word deglobalization, but kind of a different kind of globalization that takes place, because I think we will continue to stay interdependent and connected. It will just look different from what we're used to for both geopolitical and political reasons than in the past couple of decades, if not more.
Okay, and that's an excellent point on which to end the discussion. So I said we'd wrap up at the top of the hour. We've reached the top of the hour. So I think that covered a lot of ground in a short period of time. I'm grateful to all of you for joining us here today. That was Delhi's Dilemma, how to balance global politics with economic investment risks. I want to thank my 3 panelists, Tanvi, Madan, Jim Walker, and Tridib Pathak, and also our friends at Ocean Dial and their Gateway of India Fund for hosting us this afternoon. I hope to see you back soon, and wherever you are, have a good the rest of the day. Many thanks.